So again, when you start thinking bigger picture, when we look at those big double-digit returns, most of those returns are driven by our big tech companies. We're talking Alphabet, we're talking Meta, we're talking Nvidia, we're looking at Apple. A lot of the returns that we're seeing in the S&P 500, or even for instance, the QQQM, which I invest in both of those personally, that is where some of these really high double-digit returns come from. With something that is a dividend growth ETF, you're going to have a lot more stability. So when we look at the beta factors, look at a couple different things, there's a lot more stability in here, which of course, it doesn't have the very high highs, but it also does not have those very low lows that we see with traditional investments. Even thinking of the 3-year, we're at 8.26, 5-year 11.57, 10 years at 12, and since inception, which of course I believe was around 11 years when this ETF came online, inception 11.75. So when you think about the past 11 years in the performance in here, with all of the ups and downs in the market, everything else we've seen, it is beating out the regular kind of average 10% return that we're seeing out of the S&P 500. Now, when you start looking back, let's say even the last 100 years, a majority of growth, a big chunk of growth that we have seen in the growth of the stock market itself has come from dividends and dividend growth.